Hi everyone, welcome to another honeystocks.com stock market outlook video, and this video will be going out on Christmas weekend. Merry Christmas everybody. Now before I do the usual and flip over to my screen share, a lot has happened over the last month. If you picked up our last video analysis, you'll know the levels that were highlighted in that video have played out. It's been a recent bear market rally top, and I do have this week a lot of updated charts, a lot of updated data, key levels to look out for, some potential rebounds, etc. But my work has had a lot of attention, as you can imagine, due to the nature of the calls that I've made. Now, for disclosure, some of the charts that I will be walking through this week, I may personally hold some positions, and of course some of the charts will have been recommended to our clients over the last few weeks as well. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is unbelievably important for the field in which I work. And although I do use primarily technical analysis, I do look at market breadth, company fundamentals, etc. I'm definitely not a short-term day trader. There are plenty of day trading gurus teaching nonsense all over YouTube, but my work, I hope, becomes very, very clear very, very quickly. Should not be associated with that in any way, shape or form. I'm not in the market for little 20-cent moves. I'm looking for structural trends in the market, something that I help our clients with. And I'm also looking for trending markets, logical turning points in the market, rallies, and I think you'll probably find a lot of value from the work that I have prepared this week. But I think everybody wants to know is the market now about to collapse, or are we going to get some kind of rally? So again, I have some context around that. Now, maybe just to give myself a little bit of credibility, some of my recent time-stamped calls, I called the market crash at the start of the year. I called the rotation from growth into value at the beginning of the year, the bear market rally in June, the recent top in August, the recent collapse in the dollar, the most recent bear market rally in October, and the recent market top 2 weeks ago, as well as the rally in bonds. And you can go all the way back to the crash of 2020, where I got our clients defensive ahead of that crash as well. I do have a track record of being mostly correct, which helps, as I said, in the field in which I work, and I'm told by many that my work is among the very, very best. So if you do find some value from this, please do like, share and subscribe on YouTube, and feel free to subscribe and share on Twitter as well. But very, very important disclaimer, just basically says that there's not any investment advice and to do your own due diligence. And as Twitter says, I'm a former Deloitte hostage, very risk and compliance focused background, and I am also working towards my CMT. So enough about me, let's dive into the charts and let's see what the market's telling us. So I think the logical place to begin this month's analysis is with the S&P 500. Now, if you picked up last month's analysis, you'll know that I was highlighting this level here as a big level of interest, and really the implications of what a rejection at these levels would ultimately mean. Now, of course, hindsight now tells us that these levels have been significant and we have started to pull back quite a bit. Now, when we look at the major turning points in the market, for me, there's been a line in the sand. When we start to break below pivot levels, which this 3,900 level is, it really starts to switch up the gear of my work. And throughout this rally, we've been bullish on most areas of the market, aside from mega cap tech and growth tech. But now the market is a lot more challenging, and there's really not really a lot that we can take from the S&P 500 chart at the moment as to whether we move higher or lower from here. I think the honours for the most important chart in the market at the moment is the US dollar index. Now, for those of you that follow my work, you'll know that I've been banging the drum on the US dollar for the whole year. It's very much a case of dollar up, stocks down, and of course what's happened over the last couple of months is the dollar has gone down and stocks have gone up. So we have now pulled back to a big level for the US dollar, and the direction of the market is going to come down to what happens with this chart. Now, there's a lot of moving parts to it. I also like to incorporate volatility. Again, for those of you that follow my work very, very closely, you'll know about the correlation between the VIX and the US dollar index. We know that if the VIX is going down, then again stocks are likely to rally in that kind of environment. So there's a lot of, as I said, moving parts. We've got the bond market, I think, have been leading stocks higher for the last couple of months as well. I did cover this chart last month. I had a few questions on it, but ultimately the bond market has led the way. S&P 500 has rallied over the course of the last couple of months. The message that we've given to our clients and members over the last couple of weeks is really just to pay attention to these levels in the market and to perhaps think about defensive action, booking profits, active risk management, hedging is of course a big component. But the market at the moment is now starting to get very, very choppy and very, very, very messy at best. Now, that doesn't mean that there's not opportunities. That there are plenty of stocks that are doing very, very well, both long and short opportunities in the market. It's really a case of just judging each individual area of the market and each individual chart on its individual merits. I don't think there's anything wrong with that. But we've got the aggregate US bond ETF. Now, for those of you that again follow my work, you'll know that I made a call for a rally in bonds a couple of months ago, and again ultimately that has played out, but we are now starting to chop around at pivot levels in the market. We've got TLT again running straight into overhead resistance. Our message over the last week has really been with TLT to start thinking about actively managing risk and maybe think about booking profits. We've got the Dow again has been a star performer when we compare it to the S&P 500 this year. Again, running straight into overhead resistance. Now, we've got the 10-year note. Now, I had quite a few questions on this privately after last month's analysis and why the 10-year note for me is just as important as the US dollar index at the moment. Now, for me, the 10-year note broke trend, as we can see here. Ultimately, it's rebounded from pivot levels, but I keep getting asked literally on a daily, weekly basis, when is the money going to move back into tech names? This is a very, very important chart because there's a very strong inverse correlation between the 10-year Treasury note yield and the tech sector. Hopefully the chart really shows it. I do my best to present data so that it's easy to understand. Hopefully you can just understand that they're just moving in opposite directions. So in order for tech to meaningfully go up, the 10-year note has to meaningfully go down. We're not seeing that at the moment. Yes, it broke a long-term trend line, but ultimately pivot levels for me are more important, and we've found a big level of support here for the 10-year note. So I'm not really seeing anything that will say that there's going to be some big massive rotation back into tech at the moment. I think for that to happen, I think you need to have a breakout in the S&P 500, and you also probably need to see the 10-year note fall away, and ultimately that will then drive the money back into the growthier tech areas of the market. The charts are really a non-debate. I posted this chart to Twitter a short time ago, just highlighting the value versus growth narrative. Coming out of the dot-com bubble, we had a massive outperformance in value names, and ultimately growth tech areas of the market went on a massive tear, but now we are starting to see a very clear shift in market dynamics, and value stocks are leading the way. So this has really been the focus of my work for the whole year. Those of you, again, that follow my channel and follow my work on Twitter will already know this, that there's barely been any tech names this year that I've been remotely interested in. We've got the small caps. Our message to our clients and members a couple of weeks ago was to pay attention to this level because the chart is range bound. We know with ranges they tend to move from the bottom to the top and to the top to the bottom. So with small caps, we've actually got a downside level here of around 163. I think that's probably a level where I would be looking to communicate buy positions perhaps for the small caps, maybe the small cap ETFs, small cap value, depending what the value versus growth narrative is doing at the time. The other thing to say is the chart might not even make it to the bottom of the range. I'm just highlighting that this would be the optimal buy point, and this is really the central narrative, I think, to my work. We've got the triple Qs, again, highlighted this one last month. It is massively underperforming the S&P 500, as I'm sure most of you already know. It is flirting with testing recent lows again. We've got consumer discretionary versus staples. Now, this is one of those charts that I got asked about during the week because I posted a chart to Twitter just highlighting that I like to use this chart. And ultimately what the chart is showing is, of course, a very strong correlation between the two charts. But when we start to get an oversold reading in this ratio, we tend to find these big market bottoms. Now, this is something that I'm paying attention to at the moment. Again, I'd very much like to see stocks rebound and start to move higher because I prefer smooth, nice uptrends as opposed to choppy, messy downtrends. So I'll be looking at this chart for some kind of hint as to whether or not we could be approaching some kind of bottom in the S&P 500. Now, what I would say is I'm going to go into some charts now just for individual names, some individual sectors. I'm going to break down the charts in a very clear, concise, easy to understand way, but it would really mean a lot if you are still here that you hit the like button. It tells me that you're getting a lot of value from my work, and it tells me that you'd like to see more of it. Now, unfortunately, my uploads to social media for video content, my time is incredibly limited now, but I will try to upload once a month. So if you hit like button, share, comment, share it with your social media followers, it would really mean a lot. But what I want to just quickly touch on here, now this isn't an analysis by any means, but what I want to just highlight is really sector analysis and why sector analysis is incredibly important. Now, again, hindsight tells us that Nvidia and Tesla started moving in opposite directions a couple of months ago. One has been massacred and the other one has had an unbelievable performance. Now, I'm going to get into the individual charts, but it really does start with the sector analysis and, of course, with the semiconductor ETFs. Now, when we're looking for optimal buy points in the market, we're looking for big support levels. I really like it when we get big drawdowns in individual areas of the market, and basic support and resistance levels help a lot. Now, whether or not you subscribe to the use of Fibonacci, just as an FYI, Fibonacci doesn't have merit on every single chart. I think that's maybe where a lot of folks fall victim to using Fibonacci, not understanding that each chart is different. But semiconductors have had a massive outperformance for the last couple of months. I highlighted this one on the 13th of October. Now, my chart for Tesla has, of course, been focused on where can we buy the damn thing. Now, with Tesla, I'm sure like most of us, we all appreciate Elon and his work with Tesla, etc. But we are now approaching massively oversold conditions in the Tesla share price. Now, the last time we reached these levels back in 2016 and 2019, these levels ultimately proved to be bottoms for the stock. Now, the big question that I have at the moment is, could this potentially be the area and the time to finally move back into Tesla? And I think we're getting there. But what I would want to say is something that I look for very, very specifically. Yes, it is great that we can identify, massively oversold readings. Technical analysis kindergarten will teach you that. But what it might not teach you is really just looking for, instead of buying blindly, I like to get some kind of signal that the market is telling us that there are buyers here. And I think a good example of that is a recent bottom call that I made on KWeb and what I'm looking for in Tesla. And with KWeb, we can see back on the 24th of October, I've again looking for these buy signals, and ultimately this played out. But I'm looking for a candlestick chart to tell me that there's buyers that are stepping in, and we call these pin bars, or at least I call them pin bars. And we just want to see that massive buying volume come in, and then of course the trend can really then start to get off and running. And if you look at something like KWeb, that's an 85% move in a couple of months. So I'm looking for something very, very similar with Tesla. Hopefully, that helps somebody out there that's maybe out there and just buying blindly. But then you compare it with something like Nvidia, and I think with Nvidia, very, very clear to me that we're probably that there's some kind of basing pattern here. I'm hoping for the 50-day simple moving average to ultimately hold, but I would like to see semiconductors move higher from current levels. It's very, very difficult, I think, if Nvidia starts to break even lower. I think then maybe the chart pattern could potentially be rendered invalid. But I still like Nvidia. I still like semiconductors at the moment. Perhaps my views change early in the new year, maybe even next week. For disclosure, I will change my thesis on any chart on 30 seconds notice. But of course, I cannot communicate to social media, every single change. So it's very, very important that you're able to carry out your own due diligence, have your own risk management processes. I get asked a lot about Amazon and Google. I think Amazon is perhaps at a level where you might want to pay attention to if you're looking to buy the dip. I think you can say the same for Google. Google, for me, is in a pretty clear sideways choppy range. I don't mind range-bound charts. I think it's very, very clear. You buy at the bottom, you sell at the top, and you just get out of town if it starts to break lower. Very, very similar with Apple. This is actually a chart that I've put to our clients this weekend, just for the Christmas period, hoping for some kind of rebound in Apple. But again, if it starts to break below these levels, then that's a big, big problem. Netflix met our upside objective a few weeks ago, and now it's really just a waiting game. And for me, I would be really interested in Netflix if it pulls back to that $250 level. We've had a big rebound from logical levels on ExxonMobil. Again, got an upside objective here now of around $115. We've got the copper miners. Again, the target, this is from our sector and ETF chart book, which has around 50 to 60 individual ETFs and charts at any one time. And of course, logical upside targets. I think in that environment you can look at things like Freeport-McMoRan, Southern Copper, etc., which have been two of the names that our clients and members are into at the moment. We've got ASC, the chart does continue to move higher. Marine shipping names, if you don't know by now, you can have a look at the boat ETF. It's performing very, very well and starting to come off its lows, breakout at 1050. The trend is still very, very much intact. Likewise with Scorpio tankers. Again, I covered this chart last month, so I feel like I should cover it again because the trend is still intact. So we'll see how far ultimately the marine shippers want to move. Again, Simon Property Group. Again, for those of you that are maybe focused on your growth tech names, I understand property, real estate companies, etc. are not going to be the most exciting. But these charts, these stocks can move 40% in a couple of months, and for me that's pretty good. But we're waiting for a further breakout here above 123. We've got ELF, Beauty, again massive uptrend breakout. It is still holding firm despite the choppy market. Again, we're looking for a further breakout here above $57. The silver miners, again moving very, very well. Again, upside objectives here around $31, $32. Gold is moving very, very well from its lows. I think if the gold bugs are going to have their week to months in the sunshine, now is probably the time. I think gold is performing pretty well in the current market environment, the chop that we've had over the last couple of weeks, and again upside objectives here. I'd expect the gold ETF, if we can get a breakout here, I think we could be off and running, and upside objectives here around 193. The junior gold miners, again, maybe gold isn't your thing, but gold miners, those things can move like growth tech names. We've got DE potentially looking to break out of a massive cup and handle pattern. But to the other side of things, there are some charts that are showing a lot of distress at the moment. Now, a lot of my work is featured in the chart report, which is a big online publication. You can find them on Twitter. They're absolutely massive. I love what Patrick is doing over there. And my work, that this chart was featured, I think yesterday or maybe the day before, I posted it to Twitter, just highlighting the two areas of the market, consumer discretionary, the ARC Innovation ETF are now breaking below key levels. Now, what I would say about the ARC ETF is, of course, a lot of the individual names are growth oriented, massive PE ratios. A lot of them are in massive downtrends, but going back to what I was saying before is, the weak tend to get weaker, and the strong ones tend to get stronger. And we're seeing a big breakdown in the ARC ETF and consumer discretionary names, which makes sense to me because obviously consumer discretionary spending is being challenged at the moment just because of the economic environment and everything that everybody's having to deal with at the moment. But the ARC ETF is interesting to me at the moment because that plays into the growth versus value narrative that I presented at the start of the video. And I think if the ARC ETF continues to go lower here, if there's a lot of selling pressure in ARC, again, I think that's a big problem for a lot of the individual components found within the ARC ETF. Some of the shorts that we've recommended to our clients over the last couple of weeks, and many of these charts I've actually posted to Twitter as well, is the coin base, which is 3.5% weighted within the ARC, and it's just broken below $40. I think we all understand that the cryptocurrency space is just being destroyed at the moment. Very difficult to make a bullish case at the moment. And for me, it's really about not fighting the trend, understanding that when we get these breakdowns, that it offers opportunity, maybe for put options, for example. I don't really advocate going short names like this that can rally 15% overnight. I think risk defined options make a lot more sense. We've got Roku. Again, this was recommended last week to our clients. 6.5% of ARC. I've seen recently that Kathy Wood has added to her position in Roku. For me, I'm not really allowed to publicly slate anybody. I think the charts really just speak for itself. I don't understand what's going on at ARC. We've got massive PE ratios. The earnings growth is being destroyed. There's not a bullish case for me at the moment. Yes, you will deal with these rallies for 2 or 3 days where the stock moves 20, 30, 40%, but you can't really time those. Those are just bear market rallies. But a lot of the names within ARC are in massive downtrends, and they are only getting worse. So if you are somebody that's bearish on the market, I think you could probably start to dig into some of the individual names therein. GameStop again, meme stock. The stock is of course complete garbage. I think if it breaks below 1875, I think it probably goes lower just as fast as it gone up. So yeah, I think PBW, again, a lot of the clean energy names. I posted this chart to Twitter the other day, breaking below a key $40 level. This is again one of the charts from our ETF chart book. We've got the commodities markets, again, just holding up on big levels. Again, there's opportunities everywhere. This is maybe a chart for maybe the professionals among you that follow my work. It's not about individual stocks. It's not just ETFs. I also cover the commodities and the currency markets. But big breakout in sugar over the course of the last week. We've got GDXJ, again, another one of the gold miner ETFs, looking like it's potentially breaking out. And if we like gold miners, again, there's some charts within gold miners that can make a lot of sense. So there are a lot of opportunities there. There's really a lot to take from the markets. It's not all about the S&P 500 and the chop that we're seeing across the board. I think if you look a little bit deeper, you can still find opportunities, but it's really a case of just digging into the markets and finding the setups and finding the charts that are showing that relative strength. I think that helps a lot. Now, if you are somebody that has just stumbled across my work for the very first time, please do, like I said, like and subscribe. But feel free to go and check out our website at honeystocks.com. We provide technical charting, professional grade research with all of our memberships. We provide our premium weekend analysis. So every single Saturday, provide a 10-minute video overview of the market with some ideas for the forthcoming week. Drills into the commodities markets, ETFs, etc., etc. We provide high conviction investment ideas, which I'll show you what that looks like in a second. We provide a 5-minute halftime report every Wednesday. We also provide access to a wonderful community. We provide access to all of our chart books on our platform. And if you are somebody that's maybe in the process of learning a bit more about technical analysis, process building, etc., we also provide full access to our complete technical analysis program. It's not something that teaches you what an RSI is. It's not something that teaches you what a moving average is. It's something that helps you to build a process and bring everything together. So for those of you that are maybe new, it might help to build some kind of process as well. But to show you what our ideas look like, we've got the commodity ETF. This is a short idea that went out. We've got Netflix, massive winner. We've got ConocoPhillips, which was a massive winner. But there's very clear instructions on all of our high conviction ideas. We also log every single one of our ideas on our website for complete and open transparency. So feel free to go and check that out on our website. I also have a link to all of our time-stamped big market calls over the course of the last few years. I think it's very, very important for the field in which I work. But feel free to go and check out the ideas that we've presented to our clients and members over the last 5 years now. So yeah, it's all there for you to make any informed decisions as to whether or not my work would be a good fit for you. We are primarily trend followers with elements of swing style investing as well. So if you are still here, thank you very, very much for watching, and I hope to welcome you soon. Thanks as always.